Thank you, David. Okay, tonight we're going to talk about what happened in the markets last year. We're also going to talk about what we can expect in the coming year, something we're calling four-season investing. We're going to look at two events that happened last year that we think impacted the market in what we're calling a perfect storm, and then a longer-term issue that we're referring to as an inconvenient truth. So let's look at the market. This is the S&P, the US S&P 500. Last year it was down just over 4%. But the pattern it moved in was very seasonal. Early in the year, the markets were very volatile. You can see in early February, the market corrected for the first time in 10 years. It was down over more than 10%. But almost right at the beginning of spring, the market turned around, and you saw a nice, steady recovery for spring and summer until the end of summer, the market started to turn down again and bottomed out. Christmas Eve, it was down from peak to trough almost 20%. A bear market is a 20% decline, peak to trough. You almost got to a bear market in the US. Canada was much the same type of seasonal pattern. Again, the S&P TSX was down almost 9%. And you could see, again, you saw that correction in early February and that same seasonal pattern as you got into spring and summer. And eventually, you had it bottom in December. But you can see the market in Canada peaked a little bit earlier. It peaked on July 12th. And then we saw by December 24th, the market was down just almost 17%. So a bit of a shorter summer in Canada, unfortunately, but you didn't see quite the same kind of decline. Now, Canada and the US avoided a recession, or rather a bear market, but a lot of global markets did not. And what we've done is we've constructed our own proprietary barometer. And what that is a bar graph, and we show all the global indices, and we put a line at 20%. So anytime the bar is greater than a 20% decline, it shows that the market last year was in a bear market. Again, North America, you can see most of the indices did not reach a bear market. However, the Russell 2000, which is a small cap index, and the NASDAQ, which is technology, actually did go into a bear market, as well as Mexico did. You see Argentina and Brazil, South America, firmly in bear market territory. Europe, not quite. Germany and Italy were in bear market. And then in Asia Pacific, you can see almost all the markets, with the exception of India, went into a bear market. And you see China, with the Shanghai Composite, down over 30%. Now, as we saw with the Canadian and US markets, we saw a recovery at the very end of the year and into the first quarter of this year. And you can see that here. And we'll put down, again, that 20% barrier, because if a market goes up 20%, it's back in a bull market. And again, you can see the NASDAQ and the Russell moved up more than 20%, so they're back in a bull market. Same with South America. Europe, not so much. So Germany and Italy are still in a bear market. And Asia Pacific as well, with the exception, look at China up over 25%. China's back into a bull market. Now, turning to the fixed income markets, this is the US yield curve. You can see where the yield curve was at the beginning of last year and where it ended last year. And the yield curve moved up and flattened last year. And you can see that with the 2-year yields up 60 basis points, 10-year yields up not quite as much, 28 basis points. In general, what this was telling us was the economy was doing very well because yields were moving up. One thing of concern is you can see right here on the left, that sort of kink in the yield curve, that little inversion on the short end is something we're going to talk about a little bit later in the presentation. Canadian yield curve acted much the same way. You can see where it was at the beginning and the end of the year. The yield curve in the short end, the 2-year, moved up only 18 basis points. But this is interesting because the 10-year bonds in Canada actually went down 8 basis points. So the yield curve in the 10-year, it flattened even more. And that's indicative of a weaker economy in Canada. So again, now and you can see a bit of a kink in the Canadian yield curve, not as much as what we saw in the US. So let's broaden this, look at global fixed income markets and also real asset markets, and bring out our barometer again. And you can see the bond markets globally, again, they were generally weak because interest rates and credit spreads were widening globally. We also saw the impact with REITs, with real estate. They were also down because of higher interest rates. I will say, though, our hard asset real estate funds and LPs did considerably better than this. And commodities were also very weak, with oil, gold, copper, lumber all being down in negative territory. You know, and even some of the more exotic asset classes like cryptocurrencies, like Bitcoin and marijuana stocks were down significantly. But like with stocks, what was down last year has recovered this year, and we've seen a good rally so far into the first quarter.